When in doubt, zoom out. That's an OG statement by the Bitcoin community saying that we should be buying bottoms, etc. But actually, since beginning of Bitcoin, we have had it very, very easy. This is based on this chart behind me. In this video, we are going to look at the S&P 500 over the very long term, so the US stock market, and we are going to look at long-term PE ratios, so relative valuations. We're going to look at the S&P 500 relative to monetary supply. And what we see here on the right, this vertical line, that's when Bitcoin had been launched. So since the start of Bitcoin, the S&P 500 actually never saw a real major correction. Bitcoin was born out of the global financial crisis. Now this tells us several interesting things. Whenever we zoom out of those long-term Bitcoin charts, we actually might not be zooming out enough because we've never seen a massive global liquidity crunch during Bitcoin's existence. What's also interesting to look at is how much does it actually pay off to try to time those super macro cycles, right? Try to wait for the next potential global financial crisis. Let's have a deeper look at those relative valuation charts. The indicators we are going to look at are used by the best investors of all time. For example, Warren Buffett. So let's again look at this in more detail. So this is the S&P 500 on a logarithmic scale starting in 1871. So this is 150 years of data. What we've got over here is the Great Depression. This put so much strain on multiple economies around the world that World War II started. What we've got over here is the global financial crisis. What we've got over here is the dot-com bubble, or the subsequent bust of that bubble. Now let's have a look at the Shiller PE ratio. It's also called the CAPE ratio, so the cyclically adjusted price to earnings ratio. And this indicator is inspired by teachings of Benjamin Graham. Then it might make sense to smoothen out the price to earnings ratio over the last 5 to 10 years. The Shiller ratio takes an average of the inflation adjusted 10-year earnings. And Benjamin Graham's teachings were massively influential on Warren Buffett. So what we're looking at with the Shiller PE ratio of the S&P 500 is how expensive are stocks relative to their last 10-year earnings. What's the price of stocks relative to their earnings in the last 10 years? And sometimes this tends to peak, sometimes this tends to depress. And over the long term, this is actually going up. Potentially because wealth accumulates in fewer and fewer hands, and maybe also because investing in stocks nowadays is super common. It wasn't that common 100 years ago. So the Shiller PE ratio tends to even slightly increase over time, and it was at massive heights during the dot-com bubble. Now let's say you looked at this chart back in the day, right? And you've seen that the Shiller PE ratio was at very similar levels. Let's say you decided to sell over here in April of 1997. Was that a great idea? The answer is not necessarily. Stocks still went up by 64% afterwards. And yes, we did see lower prices afterwards, but not by much, right? Only by 13%. If you'd of course continued to sell and sell and sell, you would have gotten a higher price, and then this CAPE ratio would have been a nice indicator. But still, at that point in time, nobody thought that we'd see all-time highs on this PE ratio. Now, during the global financial crisis, we actually did not see levels that are comparable to the Great Depression. The Great Depression saw PE ratios overall in the S&P 500 of only 6 on average. During the global financial crisis, we went to 13. Now, what's interesting to note here? I don't think that the Shiller PE ratio is perfect to time tops or to time bottoms, but there is something interesting since Bitcoin's launch. When we zoom into this Shiller PE ratio since Bitcoin's launch, we can see that it went up from 13 to currently 32. It increased by 140%. So since Bitcoin's existence, US stocks tended to become more expensive relative to their earnings. A lot more expensive. And it is possible to imagine that we could see a reversion to the mean again. But here's the thing. Let's say the Shiller PE ratio was to drop, maybe even below that equilibrium. Are stocks, relatively speaking, really going to see a massive price hit? I'm not so sure. From this top over here, with a 40 Shiller PE ratio, reverting to almost the mean. The S&P 500 went down by only 26%. To me, it seems easier not to try to time the stock market, but to simply just take advantage of lower prices whenever they happen. Here are the videos that work on YouTube. XRP will be $12,000 guaranteed, or an AI explosion, top 3 cryptos to buy in November. A lot of pushing of greed, that's what gets the clicks. What doesn't get the click is a tutorial on how to make backtests, on how to build those sheets that in the end figure out what historically worked well in the past. The backtest that I often show here on this channel. I still very much enjoy producing this kind of content though. I also share these kinds of sheets, but I don't do it on YouTube. You also get direct access to me. Feel free to check it out. It's thebitcoinstrategy.com. And the reason for this is that the volatility in stocks simply doesn't seem to justify this, right? The volatility in Bitcoin does justify timing the market. There we can see from top to bottom drops by 80% or 70%. So it does make sense to try to sell high. For the stock market, the drops tend to not be that massive even when they're relatively expensive, because earnings tend to fluctuate quite a lot over time. And that's why the Shiller PE ratio tends to fluctuate quite a lot. Now let's look at another indicator. Let's look at global money supply. What you've got here at the bottom is the S&P 500 divided by the US money supply, by USM2. So since 1959, so in the last 65 years, stocks outperformed monetary expansion only by 30%. When we look at the crash of .com all the way to the global financial crisis, we have seen a drop of the S&P 500 by more than 70%. Now, why does this drop now look much larger compared to the US dollar valuation drop? That's because global monetary supply tends to expand a lot during a massive crisis. In other words, the Federal Reserve tends to print a lot of dollars during times of crisis. That doesn't mean though that your purchasing power doesn't go down, right? Measured in USM2, the crashes are pretty massive, not that different to Bitcoin's crashes. But what does this chart also tell us? Again, we have had it very easy since the launch of Bitcoin. Stocks in aggregate outperformed US money expansion by 183%. Now, I don't know what this means long term, right? Rarely have we seen levels like this. Now, what does this mean? I interpret this in the way that when we look at long-term Bitcoin price charts, that whatever kind of bear market we have seen in the past might still be somewhat tame, relatively speaking. We might see even more massive bear markets in the future. We might. We don't have to. We might. Now let's have a look at a long-term Bitcoin price chart, and let's have a look at what could be the worst case scenario just within the volatility that has happened so far within Bitcoin's existence. Here's the most bearish of the long-term Bitcoin price charts I could find. What we're seeing here is the long-term holder realized price. So the cost basis of the long-term holders in Bitcoin. And at the end of each bear market, we tended to fall even below that long-term holder realized price. And currently, that long-term holder realized price is at $21,000. So that is within what we have already seen in Bitcoin's history. $21,000 is the worst case according to this chart. But according to this chart, this might not even be the worst, right? Because again, Bitcoin lived during a time when global asset prices tended to outperform monetary expansion. If there was another .com-like bubble, or if there was another global financial crisis, then we'd suddenly see this line go down quite a bit, much more compared to what we've ever seen during Bitcoin's existence. And then maybe even a floor like this blue line, the long-term holder cost basis, might be optimistic. I do not have a crystal ball either, right? But I simply just want to make everybody aware of what the potential risks in the absolute worst case could be. If we suddenly see a meltdown of all of traditional finance, and that then moves partially over to crypto, maybe we could be seeing prices nobody ever expected. Bitcoin in the end is still a risk on asset, and having a portfolio that balances out some some of that risk that is not highly correlated with that risk, for example, by owning long-term government bonds or by owning gold, I believe makes a lot of sense. You do not want to have 90% of your wealth just in crypto. This is not a channel that hypes up crypto prices. I try to be as objective as possible. If you appreciate this, feel free to give this a like. Feel free to also subscribe. I publish videos regularly. In case you've got Telegram, then you are more than welcome to join us. The link is down below. It's 100% free. Looking very much forward to chatting with you. Cheers.